Welcome to the practical portion of the Market Maker course. In this section we are going to apply all the theory that we saw in the previous lectures, but this will be done in a more comprehensive and nuanced way. What I mean by that is that in order for you to really grasp how market manipulations occur, you need to be exposed to several different practical examples. The theory is not enough to understand how these things play out in real charts. In this video, I'm going to analyze one of the live trades I posted in the YouTube channel, but here I will analyze it completely under the light of the market maker strategy. The same exact trade could be placed using the fractal flow strategy. It's interesting to notice how these two methodologies can point to the exact same points in the chart. Without further ado, let's begin the analysis. The first thing you should notice in this chart is that we have a downward flow, which is recognized by the lower lows and lower highs of this market, which are marked by the short blue horizontal lines. In this chart we have also 2 points of manipulation. The first will serve as a target point for the trade you see opened in the chart, and the second one in the lower section of the chart is used as a trigger and for the stop-loss placement. The first manipulation is marked in number 1, which points to that massive candlestick going down. I'm going to go through all the steps of the manipulation so you can see how this works in practice. Regardless of what the market is doing, we always have retail traders who are looking for places to go long and places to go short. There is quite a lot of people who look at obvious highs and lows in the chart and believe those are good places to buy or sell. That comes from a raw intuition that when price surpasses a high, it has momentum to continue up, and when price surpasses a low, it has momentum to continue down. That's correct up to a certain point, but using these areas as places to trigger a trade is wildly dangerous, as you are about to see. Going back to some of the principles of the fractal flow method, buying in highs and selling in lows is wrong because we have very poor trade location, meaning that these places are usually far away from the market edges. Let's analyze what happened between number 0 and number 1. Price had just made a lower low, but regardless of that undeniable fact, there were retail traders that were ready to buy when and if price surpassed the high number 0. In other words, in the area of high number 0, we have a cluster of orders from retail traders that believe that if the market breaks that level, it will continue to go up much further. Large traders are aware that these retail traders think that way, so in this specific case, they drove price up to the order cluster to trigger the long orders. When price hit that level of the order cluster, an immense amount of people bought the market, and that's the window of opportunity that large traders have to sell the market and successfully employ their maneuver. One very important thing to understand also is that those retail traders that went long at the break of high number 0 usually place their stops a few pips below the break point. They do this because they think that this sort of thing reduces their risk, which is obviously not the case. Right after large traders hit the order cluster and the long positions were triggered, these large traders get in the market as violently as they can to the opposite side, which in this case is the short position. Before we move on to the other steps, you should be able to realize that the moments that precede the break of high number 0 is what we called the von Restorff effect in the theoretical portion of the course. When price is near that point, all that those retail traders willing to go long can pay attention to is the high number 0. They completely ignore the fact that price is producing lower highs and lower lows. After the large traders get in the market with as much violence as they can, the market obviously starts to go down, and this is where the reverse psychology and bandwagon effect begin to take place. Those stopped-out retail traders now realize that they were wrong, and they are ready to recuperate their loss by jumping in the other direction of the market. This is the reverse psychology part of the manipulation because the large traders can only trigger this revenge mechanism in the retail traders by inducing them to the opposite side first. The bandwagon effect begins to take place when a huge mass of retail traders starts to jump into the short side of the market. Needless to say, at this point the enormous amount of people who attempt to scalp the market to the downside in a situation like this only helps the market maker's position to head in the profitable position. This is how a market manipulation usually takes place when we deal with retail traders that look at highs and lows as good entry points. The aftermath of the manipulation is very simple. The high number 0, which was the level used as a tipping point, represents now the upper limit of where large sellers might appear again, and the open of candle 1 represents the lower limit. You will understand why that's important later on in the analysis. After the manipulation in number 1, observe that the market resumes its original downward trend, which is what retail traders should be paying attention to this whole time. The other manipulation maneuver in this chart happens in the lower section in number 5 to be precise. It can be considered as the exit strategy of the large sellers from the first manipulation, or it can be considered a manipulation on itself. The analysis tends to be the same regardless of which of those possibilities holds water. Although this second manipulative maneuver tends to almost mirror the first one, there are a few differences. The section of the manipulation where the von Restorff effect occurs is a bit different because it happened in the direction of the trend. That's the case because the manipulation now will tend to reverse the direction of the trend because the market is losing momentum to the downside, and those large sellers need to dump their large positions at some point. In the second manipulation, the von Restorff effect happens in number 4, which is an outside bearish candle pointing to the downside and giving the impression that the market will continue to go down. This element fills the retail traders who are waiting to go short at the break of low number 3 with hope that the market will plummet even more. At this point, the manipulation exactly mirrors the first one. Large traders purposefully drive the market down to the level 3 where there is a huge cluster of sell orders. Once the market gets there, a deep liquidity pool is created by the triggering of these short orders, and the large traders, who are now looking to go long, enter the market with an enormous amount of long positions without distorting the market too much. Remember that market makers need these deep liquidity pools to enter their positions without being noticed too much. The lower tail of candlestick number 5 represents the market makers entering the market to the upside. At this point, those poor retail traders who sold the market at level 3 are already stopped out, and they are all ready to take revenge and go long. You might be thinking that these retail traders can actually recuperate the loss of their first trade, but that happens to be false most of the times for one very simple reason. Retail traders like the ones we are dealing with here are always operating under the hyperbolic discounting paradigm. In other words, once they see some profit appearing on their trading terminal, especially after a loss, they tend to close the orders. These traders have no rules about risk management and they act almost completely by impulse. Observe how the manipulation followed the same steps again. Large traders created a distraction with the candlestick 4, then they fulfilled the hopes of the retail traders who wanted to short low number 3 as a reverse psychology maneuver. By hitting the order cluster and getting to the opposite side of the market, the large traders finish the reverse psychology effect and trigger the bandwagon effect to help drive their positions to the desired direction. Based on that, we can safely assume that this market is probably going to go up, so we simply enter the market with a long position at the open of the very next candle. The stop loss in the market maker strategy is logical as well. It should go below the absolute extreme of the candlestick that was the axis of the manipulation, which in this case was the candlestick number 5. The target can be placed in the lower limit of the other opposite manipulation that took place between level 0 and the open of candle 1. Here we can see that our trade was successful, and we were able to detect the market maker's maneuvers. One of the advantages of being able to see these things in real time is that these market manipulations often point to flow shifts in the trend, which happen to be difficult to see with other methodologies. As you can probably notice at this point, the market maker strategy can serve as another layer to the contextual trading principle of the fractal flow method. This is a very good way of enriching your analysis of the market and taking advantage of what the large traders of the market are doing.